I offered you Microsoft for $14. It's growing. I've seen no red flags. Is there a lot of euphoria here? That'd be a hard building to sell. Do the high level stuff first. That's a big key here. That's it. What are the major red flags you need to look for when evaluating a company or any investment, real estate company, whatever? So guys, the first thing I'm gonna say is there's no avoid this. Because even on overvaluation, a lot of times there can be a story if this company is small enough. Look at Palantir, right, Mo? Mm-hmm. We were speaking about Palantir at $40, $45 a share, but it was such a small company. Maybe it's possible. I don't know. It just didn't seem reasonable. But a company like Tesla, we even do the numbers now. It's like, okay, there is a way it gets to $200 a share today's value and still makes a reasonable return. But what we want to do is we want to go through the financial statements. We want to approach investing in a stock like you're buying a piece of a business, because that's exactly what you're doing. If that's the first time you've heard that, then you obviously haven't watched our channel before.
Welcome.
But that is what you're buying. You're buying a piece of cash flow. And for those of you who already do watch our channel, this is a good refresher on how I'm going to go through it basically the same way I go through how we made our 8 pillars and how I look at financials. So let's pick up a company. Let's pull up a company like Microsoft. I'm just going to pull up Microsoft because it's a very easy company to understand. So first things first is I look at the chart. And you might sit there and say, well, Paul, why do you care about the chart if you're a financial, if you're numbers, if you're believe in fundamentals? I want to see, is there a lot of euphoria here? There was a pretty steady rise here. Now, that doesn't mean it's overvalued or undervalued. But to me, it says, okay, Paul, just be a little apprehensive. It is going down now, which I do like. So maybe pay a little more attention. That's all I'm going to look at the chart. That's it. Mo does his chart reading, which I love. But when it comes to fundamentals, Mo, on this main metrics page, what are the things that jump out at you that you immediately look at?
Return on invested capital jumped out at me right away.
So guys, right here, 5-year return on invested capital of 25.3%. This company does an amazing job of getting a return on the money invested in the business. And over time, as they buy back shares, pay dividends, etc., that can keep going up. And Munger and Buffett believe that basically this is the return you can get on your money as long as you pay a reasonable price for the company. Doesn't mean pay $10 trillion, you'll get a 25% return, right? That's a big key here. These are the kind of companies that can compound on themselves and give you the multi-baggers. What's a multi-bagger? A 10-bagger is one that goes up 10 times its money. Yep. But you have to have that high return on invested capital. Can it keep generating more and more profits on itself?
On themselves, yeah.
All right. Next thing I look at is market cap to enterprise value. Yeah. The difference here will be debt. I want to see these very close to each other, reasonably close. I want to make sure they don't have a lot of debt on them. Why is that? Well, debt works the same for you as it does for a company. The more debt you have, the more likely that when things are tough, you have problems. That doesn't mean avoid companies with debt. You know, last year, Verizon Wireless, remember Mo? Yeah. Buffett and Berkshire had Verizon Wireless, and we were like, well, watch our video. We were like, we don't get why, because it has a ton of debt, and we didn't like the debt, et cetera. I think they've since sold their position.
I think they've exited the position.
Yeah, but either way, I look at it going, listen, there's a lot of great companies out there that spit a lot of money out. Let me focus on that, not companies that use financial leverage in order to get returns. Mm-hmm. I want a good, solid business that doesn't need leverage in order to make money. Yep. All right, let's go next to our income statement. Very first thing, I just look over a 10-year period. Oh, look at this, revenue growth. Yep. I just like steady revenue growth. Now, one thing I will notice, look at this big jump right here.
Yeah, huge jump.
What was the huge jump here, Mo?
COVID.
Yeah, so people spend a lot of time at home. They probably have to spend a lot more money on software and Skype and all these other things that Microsoft has. But that's the first thing I'm going to look at is say, are there any areas where I go, well, why was there a drop here? Oh, sorry, not there. Oh, there wasn't a drop. There you go. Even better. It wasn't even a drop. I read that wrong. So these are the things I look at saying, and it's not a, oh my God, avoid it. It's a, so recently shipping companies have had massive increase in revenue, right? What was that shipping company we looked at recently?
Zim
Holdings?
Zim Integrated, I think.
Whatever. Yeah. And their revenue like quadrupled or something like that in 2 years. Why? Because we knew shipping, because we import things all the time. A container from China used to cost $4,500 and it cost $25,000. That's not sustainable. No. So we immediately knew, watch out, be careful. And that's part of the things you look at. Next thing I look at, I don't really look at gross margin, even though I should, but I just want to make sure it's around the same number. But I immediately go to net income. I do the same thing.
Big jump.
Now, net income is going to be a lot less consistent, but you want to see a trend going.
So I will say, even since 2019, the trend has continued in that 40 plus range. I mean, it's correct significantly, but it's stayed.
But like right here, 21.4, 22.6, 24, 12.5, 21. Yeah. Something happened here.
Something happened, right?
Now, if it was one time, I'm okay. But if it starts going like this, I'm like, okay, I need to figure out What's going on with this company that makes me go, all right, let's figure this thing out. What am I looking for? Red flag. So far, guys, I've seen no red flags, in my opinion. I just sit there and say, okay, everything looks fundamental as a business. And look, I haven't looked at valuation yet one bit. Next thing I look at, shares outstanding. They're buying back shares. Now, Mo doesn't like it. Mo, I know why don't you like it, buddy?
Because they've been doing it every single year, irregardless of the price.
Irregardless. He was joking when he said that. All right, balance sheet. Now, guys, I just want to make sure they have plenty of cash. I mean, look at this cash. It's just, yeah, this is quarter by quarter, and it's decreased, but they have plenty of cash going. Yeah. They have $100 billion in cash, $160 billion in total current cash with inventories and everything. Debt, long-term debt. Let's go check out long-term liabilities. They're decreasing. Long-term liabilities are decreasing.
Awesome. Yeah.
I'm looking at this saying, okay, so cash is going up. Long-term liabilities is going, total current assets is going up. Actually, it's going down slightly, but so are long-term liabilities. And I'm okay with that. So maybe they're like, hey, we're going to pay off long-term liabilities with this cash. Yeah. Okay. It's just making it safer for me.
They have enough of it.
Yep. Now, one thing I want you guys to remember, when it comes to the asset side, I basically ignore all this, goodwill and intangibles.
Why? Because
it's goodwill. It's like, no, I want the hard assets. Show me the cash, show me the buildings, show me the things like that. And for a software business, I really don't care about the buildings.
Exactly.
It's cream on top. I don't care what their office building is worth. Right. Because guess what? If Microsoft went under tomorrow, that'd be a hard building to sell.
Yes, it would.
Because they're so large, that's a lot of, I mean, who are you going to find to take it over? Maybe you would.
Maybe, or you find multiple businesses to move in there.
And that's going to be a lot of work. And they're probably going to be worth more to Microsoft on their books. Yeah. Now, granted, they might be depreciated like crazy. Right here. They have $61 billion in accumulated depreciation. That's why I don't want to deal with this. I don't deal with any part under, basically this. This area right here, I just ignore. Because I don't want to deal with it. To me, it's not going to tell me much about the business. Mm-hmm. And if this is what makes the business worth it, I don't want it.
Move on.
All goodwill is if I buy a business from you and has $5 in book value, assets minus liabilities, if I pay you $20 for it, goodwill is $15. It's the amount you paid over the book value. So I can make this number huge by overpaying. Right. That's why I don't care about this. I don't want to overpay. So why would I give it value? That's the big key here. Now, finally, the cash flow statement. And again, no red flags yet. So the cash flow statement. First thing, I want to look at cash from operations. 29, 32, 30, 36, 40, 45, 52, 66, 82, 88. See a pattern here?
Growth.
Yeah, it's growing. Cash from operations keeps going up. All right, capital expenditures. Are they investing back in themselves? Now, if you want to go a little step further, you want to see percentages. All right, so back here, it was 15% or so. Here it was 25%. Here it was 25%. Here it was 30%, 28%, whatever it is. Okay, it's increasing. Okay. So my first question is, okay, are they investing back? What are they investing in? This is capital expenditures, investments in fixed assets. Why are they investing so much in fixed assets? But again, they're spitting off so much cash flow. My next thing I'm gonna look at is 23, 27, 23, 27, 32. I mean, look at this increasing in free cash flow.
It's incredible.
Yeah. Another thing. Acquisitions and dispositions on the cash flow statement. If it's a negative number, it's money laid out. They've bought something. If it's a positive number, they've net sold. 5 billion, 5.5, 6, 9, 8, 13. Wrong one. 500 million, 6 billion, 4 billion, 1 billion, 26 billion. So some big acquisitions in here. Another big one. That's the thing. What are they acquiring?
Big one might be coming 2023.
Yeah. Activision Blizzard.
5 billion?
I don't know what the exact number is. So I look at this saying, okay, they're making acquisitions. Are those acquisitions making a material benefit to their investment?
Are they just doing this to be busybodies?
Correct. Because a lot of companies want to look at us. We're being active. Look at us. We're doing all this stuff. Now, guys, have I mentioned valuation once yet? Nope. Valuation is the most important part because all these things can be perfect. But if I told you right now, pay $100 trillion for Microsoft, you should absolutely look at me and take a dump on my face and say, you're an idiot. And if I offered you Microsoft for $14, you know what you should do? You should call the devil. You should sell your mother, your father, your sister, your brother, and all your dogs to buy Microsoft. Those are the keys. The exact same fundamentals we just looked at, but different prices. I will not sell Oliver. Oliver's worth more than $100 trillion to me. That is the key to all of this, guys. At the end of the day, if these things do work out, and these things are great, then what do you pay for the company? And that's the hard part, but that's why we have the stock analyzer tool. Because you're going to input all these cash flows and assumptions about the future to determine that. Now, before we go further, I want to show you a company that might be a little bit worse. What's a company that you might consider to be worse in terms of, let's go to Verizon, because everybody knows Verizon.
Yeah.
So let's go through the same things, and I'm going to go through it very quickly. All right, return on invested capital, it's okay. It's 9%, it hits our threshold, that's what we want. Big dividend here, which Microsoft had a dividend I didn't mention before. Low PE, all right, these are awesome. Income statement. So not much growth here, Mo.
Dividend is interesting, though.
Yeah, well, we'll check that out here shortly.
Yeah,
I mean, look at this revenue growth. Not much. Okay, so it's a very stagnant business. All right, not the best thing. Let's look at net income. Net income, all right, it's up quite a bit, but it's very inconsistent.
It's inconsistent.
So immediately it tells me if it's inconsistent, I got to go on a long-term average. Like, okay, Paul, this is not going to be a fast-growing business. You got to go take a long-term average. Now, all this stuff can be done in the 8 pillars. That's what's so great about our software. The reason I created the 8 pillars was I want to do a quick recap of all the things that matter to me in a financial statement. And more importantly, you can create your own 8 pillars here. I can edit my own 8 pillars right here. So even if you don't like our pillars and there's other things you want to look, you create them on your own. Start creating your own. Of course, I don't have my own. You know why? These are my own. These are the ones I created for me. But that's the key to all of this. You got to find the parameters that get you to understand a business better and give you the questions you need to ask immediately. Don't waste your time. Don't waste your time reading 10Ks and all that stuff. Do the high level stuff first. Then go to the stock analyzer tool. If it's in the ballpark, do more research. But right now, guys, you've seen, and we look at the big thing for me that bothers me about Verizon is this.
Debt.
30 times its debt. Average free cash flow in debt. And so look at this. Dividends paid of $10.7 billion, Mo mentioned. Their 5-year average free cash flow was $8 billion. Their last year's free cash flow was 10.9. How the F do they afford this and their debt?
I don't know. Good question.
That's why I'm avoiding Verizon. And guys, hopefully this opened your eyes to understand that looking at a company, looking at a stock is buying a business, and you have to look at the company's fundamentals. So if you like the software, everythingmoney.com, we have a risk-free guarantee. Sign up 1 month. If you like it, if you don't like it, email us. We will refund your money, but I'm quite sure you will not be emailing us. Thank you for your time.